Good afternoon, everybody. Welcome back to the Schwab Coaching YouTube channel for our next topic, getting started with stock investing. And I'm your host, Kevin Horner. Today, we're going to be talking about the when to buy process a little bit, incorporating some technical analysis viewpoints into the discussion to aid investors looking for opportunities potentially to join trends at what they might consider to be comfortable or perhaps less risky levels. So we're going to cover some standard stuff, some trend lines, some support, some resistance, and some ideas that traders might choose to incorporate when considering the idea of support, resistance, and trend lines and so forth. So plenty to get to. And we also have an opportunity, of course, to look at the example portfolio we've been running for a bit here in this class, and we'll look to take advantage of some recent moves, might raise some stop orders, make some adjustments to some exits, that kind of stuff. So let's get to disclosures, and then we've got some announcements I want to take care of as well. So I'll remind you that our discussions here on the channel are fully informational and educational only. Simply, that means we do not make recommendations here. We do not endorse a specific strategy or approach to trading the market. We do discuss some technical analysis, particularly in today's class. It is important to remember that technical analysis is merely a piece of your decision-making puzzle. It's important to utilize multiple factors when basing your entry and exit positions on your trade activity. But ultimately, we want you to be thinking about it as one big, giant puzzle. And there are many, many pieces, and it can be helpful to consider multiple pieces when you are basing decisions on entrance or exits in the market. So today, our agenda is going to be discussing, like I mentioned, some trend analysis, some understanding of some key pertinent price levels that investors and traders will consider. We call those support, where we look for bounces in terms of buyers willing to step in. We talk about resistance, areas where sellers seem to take control of the price action, pushing and suppressing price lower. We'll discuss some of those scenarios associated with entering on breakouts or pullbacks to areas of potential support. I've got some specific examples as well, and we'll consider all of that today. Now, before we do, and again, I will have some specific examples for you, but before we do, I want to highlight a couple of changes that are coming to the channel, specifically changes that are coming to the channel for this particular class. One thing to make note of here, everybody, is that this class, Getting Started with Stock Investing, is moving to a Monday time slot as of next week. That'll begin on Monday the 9th. Now, we are changing the title. It is moving to Stock Investing for Beginners, and it's going to be hosted by our friend Scott Thompson. Getting back into the swing of coaching here. You can expect Scott to have this class at 11 a.m. Mondays moving forward, getting Stock Investing for Beginners. So rather than Getting Started, slight shift there. Now, what does that mean for our Thursday session? Well, the Thursday, former Getting Started with Stock Investing, we are pulling from the calendar, replacing, for me at least, with next week. The 3 p.m. slot is the ThinkScript studies. So this will be an opportunity for you to dive deeper into the usage of ThinkScripting within the Thinkorswim desktop application. It's a class I'm going to be paying close attention to myself because it's an area that I have an improvement need in. So certainly a wonderful class. And of course, Mike Fairborn is a wonderful instructor. So we're very lucky to have him hosting that one. The one after that is the After the Close segment that I'll be picking up beginning at 4 p.m. Eastern. And this one's going to be kind of like today's class, as it turns out, a review of technical criteria that can set the trader for the subsequent day. And a couple of the examples that I've got to look at with you will kind of explain that process a little bit more today. So in fact, maybe today's class will touch enough on some of that after the close concept to maybe bring you back in another week or so. In fact, I should point out, next week, the 12th, while I would normally be ecstatic to kick that new class off for you, I will be traveling to Miami, so I will not be hosting the next Thursday, 4 p.m. Eastern after the close, but the following week, I will be there for you. So check that out. Make sure you're aware of the calendar details, everybody. Remember, schwab.com/coaching, and then you can obviously build this in with emailed reminders to you for individual classes that you are able to attend live. Now, last reminder there, if you are not unable to attend live, of course, the majority of what we do is archived for you right there on the Schwab YouTube coaching channel. So please look into the archive for what you're missing on a live basis. With that, we're going to get back to the slides here. I forgot to mention, I'm sorry, our friend John McNichol there in the chat. If you've got any questions as we move through things pertinent to the topic, please feel free to post those in the chat. I'll try to monitor that as well, but I know if I miss anything, John will be there to pick up the slack for me today. So, okay, so there we go, everybody. There's our update. Let's talk about technical considerations, most notably trend analysis, reasons traders will look to participate in existing trends. Now, one of the things that a lot of traders start thinking about when they begin buying stocks in the market, they think that buying stocks that are already at lows is the way to go, because we've been conditioned by that one famous axiom, which can ruin us over the long haul if we don't really think things through, and that is buy low and sell high. Why can buy low and sell high ruin us? Well, unfortunately, buying low doesn't mean you're buying at zero, of course. The theory is that if you buy stock and hold long enough over an extended window of time, the likelihood is in your favor that price will rise. However, that's never a guarantee. And with traders, that's very different. And an individual who is looking to participate in the market with the viewpoint that buying stock at a current price is going to enable them to sell stock at a higher price down the road, well, that individual wants to probably ensure that price has already started moving in that direction first. And once they can determine that, they can then validate reasons to be a buyer into what they believe to be a new trend. And that's kind of what we're looking at here. We have the price action moving from our lower left to our upper right. That defines us as being in an uptrend. Now, that white line or light blue line you see moving through the price action, that is the 30-day simple moving average. We calculate that by taking the closing value over the last 30 sessions and adding it all together and dividing it by 30, and then placing a point on the line or a point on the chart along the way. So what it's doing is smoothing out the price action for us and giving us an average validation here so that you can discern whether you are in that uptrend or potentially breaking that uptrend. So the instances along the way here where we think there may have been a broken trend, like right here and right here in my red circles, everybody, these are instances where traders may start to consider exit strategies or sell portions of their position because they're below the average price. Some investors look at that as a signal that there could be a persistent weakness thereafter. And if that does come, they want to be tightening up their investment a little bit, right? Taking profits, building cash. Now, in these instances, it did not break down further and price moved to new highs. So the investors had a reason to stay with things along the way, even though it broke down through this smoothing average price. So some traders will rely on these basic moving averages. Now, this one, as I noted, is the 30-day simple moving average, but many traders utilize some fairly standard ones. The most standardized and ones that the majority, it would seem, work with are a 20-day simple moving average, a 50-day simple moving average, and then a 200-day simple moving average, each of which separately applies to a different time frame. The 20-day applying to traders in an approximate 4 to 6 week window, that 50-day applying to more traders in a 3 to 6 month window, and perhaps the 200-day more in a 9 to 12 month window of time for an investment time frame associated with how long you might want to be investing in your position. So there really is no good answer to the question that inevitably comes, well, which moving average is the one for me? The truth is, we as traders have to figure that out ourselves. And often stocks will, I should say, the traders who trade those stocks will have more of a belief or more of a system relative to a given moving average. And so they might very well see that in windows of time, one of those moving averages is more respected than another. Okay, so trends can be utilizing simple moving averages very commonly. We can also look at horizontal levels to define areas of support or resistance. And resistance and support are kind of like the floor and ceiling of any multi-layered structure you might be standing in. And the support line is the floor, the spot where we would expect price to maintain for us and hopefully move off, bouncing off support. And areas of resistance are where we would expect price to get beaten back. And if we look at this particular chart, you can see those couple of instances where we were at support and were beaten back to an area below. We even got above it for a whole day and were pushed back the very next day right below it. But once we got through and had some conviction with the buy, right, the move to the upside, well, then it became held. Now, one of the most important aspects when we consider technical views on support and resistance is that when what is considered to be resistance gets broken by price and price moves through it, we understand that the level that has been broken can then become support. So resistance back here, right, can then become support for us here. And that's exactly what happened. Price went up, price dabbled a little bit. We came back, we had a successful test of support, followed by another rally, and then another pullback for another successful test of support. And multiple tests of support, everybody, this is not really a negative for you. This can be considered a validation of the importance of that price level. And if that price level then gets broken to the downside like that, well, then that trader says, you know what, that's significant, and I need to heed that price action and make note of it. I need to tighten up my positions. I need to sell some stock, etc. Okay, so there's definitely some things to be aware of there. Okay, let me see. Thinkorswim can only sow first in, first out, first in, first. Okay, you're okay, Elisa. You are correct as it relates to Thinkorswim. At this time, many traders are utilizing the linkage with Schwab.com to monitor and manage the gain-loss report. Remember, that can be different, especially for those of you trading in brokerage accounts. Yeah, you may have some discrepancies there. You want to make sure that you're adjusting your exit strategies. This class won't really dive into that, but do know that when you're setting that up, everybody, you're right that the default is always first in, first out as to how you're designating those sales, but you do have the opportunity on a one-off basis to say, I would like these shares applied to a specific lot, or I would like to use on this sale, last in, first out. You have that freedom there in the Thinkorswim desktop application as well. If you are looking for more on that, everybody, search the YouTube channel for Thinkorswim detail here. You'll find some additional assistance to that extent. Okay, so after support and resistance, we can move forward into the basics of some technical indicators, whether they be some MACD, for example, or an RSI. These are simply going to be some mathematical calculations incorporating price and volume entirely. And what the goal is to do is to try and give you some confirmation detail associated with price action. And commonly, it's the movement from what are considered to be bullish conditions into bearish conditions that offer traders the opportunity to be sellers, like in this window of time, for example, or buyers in this window of time. When price has moved to new highs up here, and you notice the MACD histogram moves from green to red, well, that incorporated, it looks like it came into play right about here. Now, no movement, or right, I should say, is no technical indicator like this are going to be perfect every step of the way. But traders who are capable and spend the time to watch price action and the relationship with things like the MACD histogram or an RSI can find potentially better opportunities for entrance and exit of their trades. So you may want to give this some consideration, but it is also true that if you get too far down the path in utilizing so many of these technical indicators, then you can find yourself kind of paralyzed by the information you're working with. So don't use too many. Commonly, we traders find one that makes some sense. We stick with it until we get burned by decision making a couple of times, or you find a brand new one and then you think, well, that one's working great. It's infallible. Quick note, nothing is infallible, okay? Every one of these scenarios can work against you regardless. Every one of our technical indicators at our fingertips can go wrong at any given moment in time. Remember that technical analysis is really all about probabilities, never about certainties. So let's look at some basic examples here, everybody. You know, that's a pretty quick run through of what ultimately I wanted to cover as it related to, some of these when to buy concepts. The only thing I didn't touch on here is really volume. I'll just highlight it. Volume can be another one of those confirmatory indicators. So when we do see price moving out of a range, for example, we would like to see volume accompanying that move, kind of letting us know that there's a lot of participation in that move to the upside. And volume can be a really nice validating indicator for us. We're going to look at the S&P 500, everybody. The S&P 500 has actually gone red today after starting out green. We pushed up and hit that 6,000 level, or came close to it. Our high today, 5,999.7. Pretty darn close to the 6,000 point. And as you can see, fix 6,000. One of the things we will discuss commonly in the Trader Talk in Today's Market class that many of you are aware I host, we talk about the importance of some of these round figures and how they can play into traders' mindsets. Look at the level that we're talking about, everybody. If I zoom in, when we fell through 6,000 back here in late February, we have 59.92 as a high, 6,009 as a high, 59.93 as a high, and then 2 days later, 59.86, and then we were lower, okay? Well, now, if we looked at today is giving us a new high trade. High yesterday was 59.90, today 59.99, and now we are through, that is to say, we are lower than the low that we had yesterday. So we do have a short-term pullback underway. Certainly looks like the market is apt to carry this kind of negativity for the remainder of the day. Now, the trend has been largely up. Remember when we were talking about that moving average and trying to understand which is the most important? Well, right now, if we just showed the 20-day in orange, a lot of traders would say, well, that makes sense. That looks like the most important short-term moving average for us. Why? Well, we'd banged our head, or came to this level, I should say, a couple of times as we were trying to bounce back, right? We tried here, couldn't get through there. And then on the way back up, we actually got a lot excitable on a Monday morning. And that was when we moved from this Friday close on the 9th to the Monday, the 12th of May open, and we gapped higher. Now, if you remember, when we just looked at support and resistance on the desktop slides, we talked about how a breakout will commonly come back to test the breakout level, and that a test of the breakout level is not a bearish signal, but rather a bullish signal. And that's what we got with this move here. So we came back, we tested, and now this by itself, for many traders in a short-term viewpoint, are not likely to be buyers with exuberance on this day. But the very next day, when we gapped above the high of the lowest day in our pullback. I'm going to restate that because I think it's important, everybody. When we've undergone a sell down or a pullback in trend, like we did from here, this was about 5 days in length, right? When you undergo a pullback, the first opportunity that a buyer has to believe that a pullback has run its course is when the following day we have a close above the high trade of our low day in this pullback. Okay, so we define the low day as on the pullback as May 23rd. Well, then the very next day we closed above it, above the high of that day, and that can give traders reason to believe that there's more opportunity. And it did lead to that push into 6,000, pretty close to 6,000, right? So we added about, even if you bought it at the peak on the close that day was 59.21, you added about 78 points if you played it perfectly. Nobody ever does, of course, but had you. Okay, so what are we doing now? Well, nothing has changed from the trend stance, everybody. We can still draw a manual trend line showing that we are above the way. We've made a higher low here. We made a higher low here, higher low here, higher low here. And if we come back and found that 20-day moving average to be support for us once more, that too would be a higher low. Now, why am I bringing it all up like this? Well, because many traders will look at a candle like today and immediately say, Kevin, that is ugly. I don't like it, and I don't want to be participating any longer. This is clearly going to be the reversal indication. And you might be right if that was your position. However, the trend itself has not broken. We are not below the 20-day moving average, which would be the first time in 6 weeks plus if we did make such a move. That would be an indication of a potential trend break, and that could be reason to see traders really starting to unwind their S&P longs. But at the moment, you're not getting that from the standpoint of the 20-day moving average, which is, like I said, been maintained since April 23rd. And by the way, for those of you a little unfamiliar with it, the Thinkorswim platform can do some good things for you here. If you choose to use the lines, you can take the line from the day of the break of the 20-day to today. You can put it to the current last price at 59.25, and you can see that even from there, that's a 10.5% move to this current price. And it also happens to be 43 days, calendar days, 31 bars right at 6 weeks. So does that mean anything? Not necessarily, but commonly we see 4 to 6 week moves. When we were below the 20-day back here, how many days was that? Let's see. 34 bars. So closer to 7 weeks, right? To give you an idea. Okay, so again, just to give you some theoretical detail to work with, moving averages and a look at, boy, the S&P 500 is a tremendous tool to highlight some of these levels that we talk about, right? Whether you're a trend trader or horizontal support and resistance, et cetera, they really can be insightful. Now, one today, so this was great from a trend standpoint, looking at that 20-day moving average. I'm going to just quickly, before we move off, let's just put back only the 50-day to see if there's, where is that? There it is. So there's our 50. So some traders would say, yeah, I'll wait to buy the S&P now that it's overbought a little bit, or now that we're retreating. Some would say, I'll look for support in here. And if this comes back and tests that 200-day moving average approximately, they'd be interested. And some others would rather see the 50-day. If we see the 50-day, it's likely that the 50-day is a little higher, right? It's not going to be at the 50-day tomorrow, most likely, or as I wouldn't expect it to. Doesn't mean it couldn't. Certainly could. But most likely is that it's going to see the 50-day kind of sliding its way, drifting higher into this area. Maybe we find some support around 5680. Maybe it's 5700, another round figure as an example. That could certainly be the case. You can see we got pushed back at 5700 before, right? So that could work out too. But again, I'm just suggesting that we all have some ideas as to where these levels can work. And that way you're prepared if you visit those levels as to how you may want to act a little bit, right? Let's see. I saw your question, Heather. Let me go back up here. John, I know, answered it. Pivot points can fit into this stuff, but they are, as John points out, commonly used on shorter term charts, intra-period charts, your 5-minute bars, 15-minute bars. They can be used in conjunction with some moving averages on an intraday chart as well. But ultimately, the pivot point, it's just a calculation of the prior day's open, high, low, and close, and it gives traders an approximation of price action around which the stock, the index itself, would be trading for the day. They don't always hold up, of course. Sometimes they act as short-term areas for support or potential short-term areas of resistance. They're probably a little bit more advanced than most traders are familiar with from a class like this one, if I'm being honest, Heather. But I did talk about this in advanced charting class last week. So you're welcome to take a look in the YouTube archive there for last week's advanced charting. I did go into a little bit more depth on short-term charting and the use of trends in a shorter-term scenario. So maybe check that one out. Okay, the other one we wanted to look at today, as we were talking about support and resistance, I want to look at a stock that today is breaking an area of support and resistance, or was at support and is broken through some resistance. And so I was watching this one recently. Nebius here had run a couple of times up to this $41 a share level. And I'll duplicate this chart, or that line, excuse me, and bring it back to the ledge that we moved from. Basically, the stock pushed from a $35 price up to a 41 and change, 41 and a half. But before today, we didn't know that the stock was going to be juicy and start crushing higher. But I did look at this and was hopeful, of course, that that's what it could do. But this is how the chart looked. And what was it that caught my eye when thinking about the trend analysis and the opportunity for support and resistance? Well, a couple of things, everybody. We're going to talk about the price details here. 35 a share. At this price, let me edit these a little bit so they stand out for y'all. I'm sorry, this comes in a little bit. Let's align that on the right. There we go. So there's 35. And then up here, we're going to call it 41, just for good, easy math. Okay, so we had a $6 range. We have support. Let's make it green so that stands out even better. Support there, and 41 was our resistance. So support is our floor, resistance is our ceiling. And when we move through resistance, we expect or hope that our former ceiling now becomes our floor. And as we'll see when we go forward in the chart there, with today's move, we have what many would call a legitimate breakout. I say legitimate because the move through 41 is by more than 10%, everybody. We're up at 46. That's $5 above the breakout level. So we might have already reached, for some traders, an initial target based on the height of the range from which we have broken. But a trader looking for entrance signals could have certainly been considering this candle right here. Now, why? Well, for those of you who were just here 10 minutes ago, you heard me mention the idea of a hold, a close above the high of the low day in a pullback. Well, we had a pullback for 3 days from here to here, right? And that pullback stopped, or the selling stopped, at the orange 20-day moving average. And that gave us the low trade in our pullback. And then the very next day, we traded and closed above the high of that low day. And a trader who decided, okay, that's my signal, I'm going to buy some here. They would have been rewarded, again, with a breakout. Doesn't mean that's going to go every time. But now the trade becomes management style, right? We have to consider All right, I bought it here at 30. In fact, let's pick the worst time. Stock closed on the 3rd at 37.27. Okay. So we're going to mark a line at 37.27 right here. And I'm going to make it exact. There you go, 37.27. So there's our entrance at the closing price on the day. And if we did buy it there and hold it and are holding it now from that level to where we are today at 46.5 or so, we're doing pretty good. We're up 24%. Now, again, it's not going to work every time, but what I want to mention is not every trader is going to be a buyer of all of their position here, right? Some of you would say, well, Kevin, that's a great entrance, but I want some more confirmation. I want to buy half here. And if it breaks out, I will buy another half. Some traders would take that approach. They would say, yes, the validation for me is moving to new highs. New highs in my time frame, whether short term or all time, new highs are generally not considered to be bearish in nature for the stock price. So the fact that the stock moved through this level, not just moved through it, gapped it, right? I got to call that out. We gapped that level, everybody. So not only did the stock open above the level, it just kept cruising all day, okay? And so what that's giving traders the opportunity to do now is consider their exit strategy. And so the trader here who buys at 37 is possibly saying, you know what, I'm going to take and place a stop order for an exit strategy right beneath the low of today. The hope being that it would never come back to test $41.40 or $41. And the trader who does that is trying to basically lock into a profitable trade. And I say trying because we could put in a stop order there at $41 a share. But if we do that as a stop with a market order thereafter, we run the risk of triggering under our trigger price at, say, 40, and maybe we sell it at 39.90 or even 38 or 35. The truth is we have no control over risk with a traditional stop order, and we certainly have no control over price. But the opportunity is to try and mitigate the downside risk by utilizing an exit strategy below the breakout level. Okay, so this one was really interesting today, and we'll see if this continues. The big key is going to be trying to hold the majority of today's move now that this has broken to the upside. Everything above 41 remains bullish, but as we saw, not just on the S&P, but as we saw in my slides, stocks will move higher. They will trend up for days, weeks, sometimes hours, and then quickly come back and revisit. So we don't know, one, that it has to revisit. Commonly they will. Two, if it revisits, does it hold? Does it fall through the 41 level and want to test the 20-day moving average instead? I don't know. But I do know that if I were a trader owning shares up here, I would be working to set my levels and exit strategies as it starts to pull back. I don't know what those levels are for any trader in this position, but that's a process of considering, here's what I own, here's what my profit scenario is, and here's where I'm going to start to piece out of that trade so that I can feel a little bit more comfortable. Okay, now one of the other stocks we're going to look at today is one that we got stopped out of, unfortunately. This is from our example portfolio that we discussed last week. So I'm going to talk about Dollar Tree. Now, last week's class, which you'll find in the archives if you're interested, we spent a good 15 to 20 minutes working through my example portfolio down here and adding sell stop orders to those positions that had been moving in profit. And for most of them, everybody, we did standard stops. So I put in a stop on Adobe. Let's take a look at that. So we have, I need to put in my orders. I'm going to go here and say show orders. There we go. So here was our stop. We put it below a gap level, and below the, just happened to be that because 5 days ago we were in here and we set our stop below my white line. You can see how the evaluation we did last week kept us in the trade, everybody. We had an intraday opening low under the 20-day moving average on this day, and we did not get stopped out. And I think that's because we set a good stop level. So props to us, I guess, for doing that. We'll see if this can move higher. Right now, the stock has been rejected at this same level a few times. And so we don't have a reason to raise our stop yet. If the stock can move through this band of potential resistance, well, then we can start to talk about raising our stop into this white line zone thereafter. Kind of looks like that position in NBIS we just saw, right? So if we can get the break through that white line and use the new white line former resistance as new potential support, then we can talk about raising the stop there. But just a quick revisit there. Let's look at Pfizer, JP Morgan, and then Pfizer. Same thing here. Did not make any new highs. No need to make an adjustment. Our 20 share stop limit down, a stop order down there, is a stop limit, a trigger at 250 followed by a limit at 255. This one differs from that standard stop, everybody, in that we have asked it to trigger, and then once triggered, we want to sell for at least 250. So we can trigger it at 255. That'll activate our stop order. And as long as we can sell it for 250, we will. But anything above 250 we'll take. If it cannot be above 250, we are left holding the bag. So we need to know that there's that risk associated with the stop limit order. Now, the other order here on current stock is Pfizer, and we've got that stop as a trailing stop limit, everybody. And that's interesting because we're going to look at Dollar Tree where we used a trailing stop a moment ago. This trailing stop limit, as you'll see me highlight here, is all 100 shares at a $20, started at 20, and our trail is $1.25. So our current stop is at $22.37, and that is in the parentheses there. And that is a fluid amount, right? Because if we make a new short-term high, well, then we will have a new stop price because the trailing stop the trailing stop trails price upward. Okay. So what happened there with Pfizer is we've had it on for only 5 days, and the high trade initialized there. I could tell you if I did the math on it, where our stop is at 22.37. So you add that $1.25 to that, 23.62 is our high since we've set this up. So the stop limit or the trail at 22.37 has as of yet not hit. Okay. But it's on the books down there. So it's noted down here at 22.37. So we can't see it. Oh, I guess I can see it. It's way down there. Okay. We should be seeing it right in this area, but it's popping up with this icon. So it's working there to protect us. But here's the risk of that trailing stop, everybody. Look at Dollar Tree. So I'm going to have to place not just my orders, but I'm going to have to put my trades on here. So Dollar Tree, we bought as a breakout example. Remember the breakout? Why do we buy on breakouts? Well, sometimes you buy the breakout. Sometimes you wait for the pullback to buy. We bought it on a day where where it had pulled back and turned green. And what we were looking for was an approximation to the height of our range. Remember, we talked about how the range can be added on a breakout to approximate your next level. And what I did essentially was say, okay, well, we bought it here. What is the height from the range that we just broke out? I'm going to take that and add it to the top. And that gives us a target. Well, then that target got met. And what we did was say, all right, we're going to go with a trailing stop to try and take some profits if it breaks down. But the risk is that you get a move like we got yesterday. And yesterday we got stopped out of this trade because the distance from our peak exceeded the amount by which we allowed it to fall. That triggered us, and we got a market order to sell. And so we were taken out. Now, we didn't do bad, everybody. We made $7.70 or so. That's a wonderful trade. We shouldn't be angry with it. Yet, if you're a trader watching that 20-day moving average, you're going to say, boy, I might have been smarter to just not incorporate a trailing stop, but maybe a monitored stop, meaning I'm going to place a mental level where I will take action if we close below it. Because you know what? The closing value was right on the 20-day moving average yesterday, and it did not break the 20-day on a close. And so we still have some suggestion that we've been above the 20-day for more than 2 months almost now, right? So the drawdown, or the drawback rather, to utilizing a trailing stop like this can be that it takes you out of the position before the trend is truly broken. And that's ultimately what happened to us on this Dollar Tree trade. Doesn't mean it was terrible. We should still pat ourselves on the back for an 8 or 9%, 10% move that worked well for us, and we took profits on. Okay, trading it today, trader might just say, yeah, it bounced back. I made the mistake. I'm going to get right back in, because we've had, if today is the low day in the pullback, pardon me, if yesterday was the low day in the pullback, well, then traders would say, boy, we've got every reason to maybe consider re-entrance now, because we're right back above the high of the low day in the pullback. Boy, I hope that's all been insightful today, everybody. Covered quite a bit of topics, utilizing actually the slides that we wanted to cover, but then finding the examples in the wild to really speak to the concepts covered here today. So I hope you found those helpful. Remember, we are shifting this class. Getting started with stock investing is changing to a new title, and we are getting started as early as next week. So on Monday the 9th, Stock Investing for Beginners will come back for you all with my guy, Scott Thompson. And then next week, you'll have me here Monday, Tuesday, Wednesday, but I will be out on my trip to Miami. If any of you are in the Miami area, we'd love to see you there. Obviously, I know registration's probably filled up for those market drives, but they are fantastic events. And if you're wondering, hey, I've heard about all these events, how do I get to these? How do I know what's coming? This page, schwab.com/coaching, the in-person events. This is where you can come find us when we are out and about. Now, the market drives are different than your traditional workshops. Market drives are single day. Think broad discussion, market overview, economic health and cycles, etc. And workshops, we invite you out for classes much like this one, where we want you to bring your devices and learn for 2 days. It is an exceptional opportunity. And as you can see, everybody, we are out there quite a bit, on average, twice a month between now and the end of the year. So plenty to do for you. Come visit us at one of these if you have the chance, everybody. Thanks for joining today. Thanks for being part of the Getting Started with Stock Investing series we've been hosting here. I appreciate you all. Follow me on X, Kevin Horner CS. And don't forget, there's more to come from us on the YouTube coaching channel. So I will be back tomorrow morning for Trader Talk Friday. That's ETF Friday with my guy, James Boyd. He and I are looking to talk about what happened today at market open tomorrow morning. So with that, have a great Thursday, everybody. I look forward to seeing you again real soon.